Welcome. Welcome, everyone, to Are You Ready to Take Control of Your 2025 Taxes? I'm very pleased to have you here. My name's Sally Boyle. I am the founder of S.J. Boyle Wealth Planning, a firm that is helping individuals and families plan for what's next. And I'm confident that you're going to benefit from the information that I share today. You are welcome to submit questions, send them to me. You are also welcome to a copy of this presentation. My contact information will be at the end of the presentation, and you're welcome to request a copy of it. We'll have one available in the next few days. Now, we're going to be presenting a lot of information today, and before we get underway, there's a couple of points that I'd really just like to share for you. Number one, tax planning is very individual. We're going to share some information that really needs to be meshed together, but the most important thing is for you to understand that no one strategy is right. No one idea is right, nor is any single approach right. So anything you hear today, I honestly believe you should be running it by a tax advisor or a good financial advisor, because this is relatively complex information. And as Ben Franklin told us, the only thing that we can count on really is taxes and death. But what he didn't tell us was how complicated the legislature was going to be in helping us doing tax planning, because, of course, they're always tinkering with the rules, tinkering with the ideas. And so I'm going to try to, before I get started in my regular presentation, I'm going to try to give you some idea of what the current legislation that we saw passed recently has said. First, on May 12th, the Republicans on the House and Ways Committee released, and it was voted on by the House, this long-awaited Big Beautiful Bill. Now, the proposed bill lays out some specifications of their plan for extending the Tax Cut and Jobs Act that was passed in 2017. And it was scheduled to expire in December 31st, 2025. Now, the reason I'm telling you this is because I want you to know that that legislation supported how you filed your taxes in 2024, and it will probably support your taxes in 2025. But what we can now guess is that it will probably serve as the foundation for our tax filings going forward in 2026. At a very high level, the bill would permanently extend most of the core provisions of the Tax Cut and Jobs Act, and that's what's important. That tax legislation that supported your 2024 and 2025 returns will continue. There are some modifications of the tax rules, and I'll go through those here. The core provisions will remain the same, mostly the tax brackets. Those were reduced in 2017, and those reductions will continue. But the elimination of the personal exemption will continue, and the increased alternative minimum tax exemption will also remain in place. So while others would be extended but temporary augmentations, there are some minor changes. For example, the standard deduction for an individual will remain at $15,000 and $30,000, but be increased by $1,000 for a single tax filer and $2,000 for a joint filer. And there's an interesting bonus deduction for age 65 and older taxpayers of $4,000. So now those will sunset in 2028, however. Now, one of the most contentious provisions of the TCJA was that $10,000 limit on SALT deductions, state and local tax deductions. And that's going to remain in place, but the proposed legislation actually increases it to $30,000. So for those folks where the standard deduction began to make some sense because the SALT deduction was limited to 10,000, thus limiting the amount that they could include in their itemized deductions. So if you now can deduct 30,000 of your SALT expenses, it may make that standard deduction less valuable to you because it is limited at 30,000. So if your SALT deductions approach 30,000 and you have other things in your itemized deductions, it could be that in 2026, your standard deduction will no longer be the most advantageous. And that was a pretty big combination in the TCJA, was the $10,000 SALT limit, as well as the increase in the standard deduction. Now, one of the things that has changed is for those folks who have used their business entities to facilitate their state and local tax deductions, that will be eliminated in the new proposal. You will not be able to use a pass-through entity to use your SALT deductions. But one of the advantages for qualified business, for businesses, the qualified business income deduction will go up from 20% to 23%. So for those service companies who have been using a QBI, qualified business income deduction, that number will go up to 23%. And as was promised on the campaign trail, there's going to be some exclusions from income, specifically deductions on tips and overtime. But there's also going to be an expansion of interest deductibility for car loans, which were completely eliminated. And that interest deductibility will be $10,000. Additionally, there's going to be some expansion of the use of 529 funds. You're going to be able to use it for other higher education. And so you might even find that if you are retired and you have 529 funds that were not used by your grandchildren or your children, you might be able to use it for furthering the education for yourself. Now, one of the things that I think is most significant is a reform to HSA, health savings accounts, which means that they're going to double the maximum contribution for households to $16,000. And I think that's substantial. I find that the HSA savings vehicle is almost perfect, deductible in. Earnings growth is tax deferred and completely eliminated if you use it to reimburse yourself for medical expenses. And for those of us who understand that our medical expenses could be substantial in our later years, that's perfect. That's a great vehicle. And there's another interesting thing. They've added a money account for growth advancement. And so for anyone who is born from 2025 through 2028, the federal government will put $1,000 into these money account for growth and advancement accounts, which I find remarkable. So the key point is that the House Republicans' proposed bill remains a draft. I understand that, but the fact that it retained the provisions of the 2017 bill is pretty substantial. And I would think it would be highly unusual for the Senate to completely start from scratch. So now that we've talked about current legislation and how it might give us some guidance as to how we can handle not just 2025, but 2026, let's talk a little bit about what we set out to talk about today. And first is just a recap of some of the key tax rules. We'll move on to Roth conversions. We'll talk about healthcare laws and your taxes. We'll talk about distribution strategies. How should you pull from different accounts where you've accumulated wealth when you need them, maybe retirement. If you've got taxable accounts and pre-tax accounts, 401ks, 403bs, and Roth IRAs, what's a good way to strategize with those? We'll also talk a little bit about tax smart asset location. Where should I have my investments if taxes are my primary concern? And then the next thing would be your gift tax exclusions. How much money can I get to beneficiaries before I die to facilitate my my estate planning? We'll spend a little bit of time on Treasury securities and tax-exempt municipals for folks who are on income-oriented investments. That's generating income for them. Both of these have some tax advantages that I think are worth reviewing. And then we'll finally end up with just our charitable giving. So let me first recap some of our tax rules. When we look at, let's review just a few numbers if we can. Again, in 2025, the rules haven't changed very much. Our standard deduction remains at $15,000 for an individual, $30,000 for joint filers, and $22,500 for those head of households. The SALT limitation deduction is the same, $10,000, same as 2024. And the child tax credit is still $2,000 per eligible dependent for those folks whose gross income is under $400,000 if you're married and filing jointly. The limitations for mortgage interest deductibility is the same. It's limited to the amount of interest associated with your principal and any borrowing that you have done for home improvement, subject to the limit of $750,000 total. And then the alternative minimum tax exemption in 2025 did increase to $137,000 for a couple filing jointly. And then the phase out is increased to $1,252,700. So those numbers have remained pretty much the same. Now, what we're seeing, though, that has changed is, as I said before, there's a catch-up contribution for folks who are age 60 to 63 of $11,250. That's a completely new catch-up contribution. One of the other things that is somewhat new, too, is that employers now must enroll new employees in their workplace retirement plans. It was something that employees needed to opt into, but now employers must enroll them and employees need to opt out. So if you've changed jobs and you don't necessarily want to participate in your employer retirement plan, you have to be aware that you're going to have to actively opt out. Now, one of the interesting things, there are long-term capital gains rates. We actually have three different brackets. I don't know that a lot of people understand that if their individual income is below a certain level, they actually pay nothing on long-term capital gains. And as a reminder, long-term capital gains are the sale of any investment, any real estate, any investment holding that we've held for longer than a year. Now, most of us will fall into the 15% long-term capital gain bracket. Those of us who earn individually more than $48,000 or more than $96,000 if we're married filing jointly. And that 15% bracket remains in place up until the 20% bracket, which doesn't kick in until $500,000 of individual income and $600,000 of joint income. So for most of us, we will fall into that 15% tax bracket. And the reason that that is advantageous is simply because our marginal brackets, which if we held investment assets for less than a year, are probably something closer to 22 or 24%. And so I think it's very important to understand that if we hold investments for longer than a year, we get a very favorable tax rate on any gain that we might earn when we sell them. Now, there's other ways to manage investment-related taxes, those taxes associated with our investments. And we can look at structures that help us manage our investment-related taxable income, as well as different tax advantage tools. And so the first way to look at things is what sort of structures allow us to not pay taxes on the incomes associated with our investments. And that's typically our retirement accounts, our IRAs, our 401ks, our 403bs, our HSAs. All of those will shelter whatever earnings that we have generated in the investments that are retained in those vehicles from taxes. And then there are investments that are naturally structured to not pay taxes on. And that can be annuities. It can be municipal bonds. Even our treasuries have certain tax advantages that that we should look into when we're making some of those investment decisions. So we can look at structures that will help us manage our taxes associated with our investments, as well as looking at underlying investments themselves. So since we're looking at the structure, the structured investments, let's talk about those vehicles and their limitations. Again, I said 401ks, but this applies to 403bs. It applies to any of our retirement vehicles, our IRAs. And so the reason that we want to maybe put some of our investments in there is there are certainly some tax advantages for us in that it reduces our investment or our active income. So we pay less taxes on our W-2 or business earnings. And what's happened is the 401k regular contribution limit has gone up to $23,500. But there's a catch up for those who are age 50 to 59. They can put an additional $7,500 in. And as I noted earlier, those folks for 2025 who are age 60 to 63, and I think this extends through is part of the provisions of the new legislation. There's a catch-up contribution for that age group of $11,250. Now, there haven't been any changes whatsoever to the contribution limits for the IRAs. There's still $7,000 and still a $1,000 catch-up contribution. But as you start to consider putting monies away, you know, there are substantial earnings that can be put away in these vehicles, but there are some restrictions as well. We need to remember that we can't take money out before 59 and a half without some sort of it's a 10% tax penalty for taking it out early. But we also have to remember that these retirement plans will require minimum distributions to begin at age 73. And so that's why giving some consideration to other savings vehicles can certainly make some sense. But the advantages on a pre-tax contribution and the tax deferral of the earnings can't be understated with these. Now, we do have some limitations. If you participate in your employer-sponsored plan, you can still put money away into a regular IRA, but there will be some limitations based on your income, your filing status, and the workplace retirement plan coverage. So as an example, a single workplace retirement plan participant can still put money into a regular IRA, but the ability to deduct it will be phased out between the ages of between the income levels of 79,000 and 89,000. And that has changed a bit in 2025 in that it has increased 2,000 on both sides of this range. Now, married filing jointly, the IRA contributor, the person who also has contributed to their workplace retirement plan, their phase out will be 126 to 146 for the deductibility of that contribution. But their spouse, who may not be participating in the workplace retirement plan, but would like to contribute to the IRA, their contribution deductibility will not phase out until $236,000. And that phase out continues until to 246. And that is an increase over 2024, where those that range was 230 to 240. So it's helpful. Now, there are some limitations as to your ability to participate in a Roth IRA. And as an example, the Roth IRAs, the dollars that go in are after tax. But there's always been a limitation based on income and your ability to participate in a Roth IRA. And again, it's income and filing status related as well. For a single or a head of household, the ability to participate in a Roth IRA has increased to $150,000. I can remember in the first year, the limitation was $100,000. This is true for folks who actually are married and filing individually as well. If you're married and filing jointly, the increase has your ability to participate in a Roth IRA has increased from the income limitation is 236 to 246. So there's a little bit of wiggle room there. So let's talk a little bit. We've covered the highlights of the current tax law. Let's talk a little bit about Roth conversions. And the first thing I need to say is Roth conversions are those transactions that we engage in when we've already put money into a retirement account and we want to convert some of those monies to a Roth for the advantages that we talked about before. The earnings accrue tax deferred, and there's some estate advantages as well. There is the advantages of the Roths are right here. There's no required minimum distribution withdrawals at age 73. And there are some additional estate strategy considerations in the sense that our beneficiaries, if they receive pre-tax retirement funds, they will be taking those distributions. They will be required to have minimum withdrawals, and it could complicate their tax situation, whereas when they receive a Roth and take distributions, there are no taxes. So from an estate planning perspective, sometimes doing a Roth conversion can be advantageous to beneficiaries. The other thing to consider is when you do these Roth conversions, the taxes are due immediately, but you can take those taxes from the IRA as well. So you can withdraw enough to pay both the distribution as well as the taxes. Having said that, the typical strategy that is most advantageous, though, is to put money into the Roth IRA from your regular IRA and to pay the taxes from somewhere else. Again, there has to be some consideration in this strategy in the sense that if you do a Roth conversion and feel like you've made a mistake, you can't undo it. In previous years, we've been able to do that. We can't now. But also the money that you put in there is not available to you for 5 years. You can make withdrawals of principal and earnings, earnings after 59 and a half, but principal before 59 and a half. But that ability to withdraw those contributions are limited for at least 5 years. But there are advantageous ways to take that out as well. As an example, you can, if you're a first-time home buyer, you can withdraw $10,000 for your Roth as a down payment. So the other thing to be aware of is, depending upon the state law and the local law, your Roth, while not being subject to federal taxes, might be subject to local taxes. So it's good to be aware of what the local rules are. So let's talk a little bit about healthcare law and your taxes. These are the rules that I think sometimes are not always, people are not always aware of them. And let's talk first about the additional tax on your income level that may be assessed against your income if you are above a certain income level. And it's certain taxpayers pay 0.9% more on wages above a certain threshold. And so all of us pay a Medicare tax of 1.45%. But if you're married and you file taxes jointly, any income above $250,000 pays an additional 0.9% for a total Medicare tax of 2.35%. So be aware of that. And the same is true for an individual taxpayer. Let's say that wage threshold is $200,000. So if I had a person who, an individual who had $200,000 of wages, their first 240,000 of wages, the first 200,000 will be taxed at 1.45%. But that additional 40,000 would be taxed at 2.35%. So it's good to be aware if you have manageable income, business owners, that you are aware of these thresholds. And they really haven't changed since 2013. So more and more people are being caught in these thresholds. So there's also some additional tax on your investment income. And this is what I think some people are not always aware of. You have an additional tax of 3.8% against any investment income that you earn that is above a $200,000 threshold. So one of the things to be aware of is your taxable income as you have also investment income, because once your investment income goes above that tax threshold, you pay an additional Medicare tax of 3.8%. And again, I think this isn't something that a lot of people are aware of. So now if you spend a relatively large amount on your medical expenses, you'll be able to deduct some of those expenses. Any expense that is above 7.5% of your adjusted gross income would be deductible to you in your itemized deductions. Those expenses can include a lot of things. It can include diagnosis, it can include treatment, it can include your insurance premiums, it can even include travel to and from your employment. So it's good to be aware of these medical expenses so you take the proper deduction. Again, for those individuals whose medical expenses do not hit this threshold, this is where the HSA is so perfect. Because again, if you have put money into your HSA on a deductible basis and you reimburse yourself from that HSA, you have made your medical expenses deductible. So those are great opportunities. So let's talk a little bit about this distribution strategies and what you can give some consideration to. One of the things that I encourage all people to do is to really imagine in their retirement all of the sources of their retirement income. You'll have some after-tax savings. You'll have some pre-tax savings in your IRAs or your 401ks. And you'll also have what I consider some tax-free savings. And being mindful of all of these thresholds that we've already talked about, your investment income, your excess Medicare tax on that, your IRMA, what the additional premiums associated with Medicare, just paying attention to all of those guardrails gives you some guidance as to how to withdraw from each of these particular holding tanks of your assets to if minimizing your taxes are important to you. And so it's important to really review the tax treatment of each item and mix your income in a way that minimize your taxes for you. And this is, again, why Roth conversions sometimes are a consideration, because for those of us who are older, Roths were not available to us in retirement vehicles by employers. And so sometimes giving some consideration to that conversion, if you didn't have the advantage of being able to save there, can make some give you some advantages. And one of the things in thinking about your investments is adjusting your asset allocation. Now, asset allocation is how much we put into different investment vehicles, broader investment vehicles being stocks and bonds. And so it's really a risk management tool. And so taxes should not be what drives your asset allocation decision. But once you make your decision about how much should be in each vehicle, then it can help you give some adjustments as to how much of your income or your investment income is taxable and how much is not. And of course, always being aware of your pre-tax accounts and looking forward to anticipate where your RMDs might be, your required minimum distributions might be, and their amount and the impact on your taxes at age 73 can be very important. So modeling your retirement income and giving some consideration as to how you might mix those income or create an income stream that is most tax advantage is something that I would recommend. It helps you create a strategy that will be most advantageous to you and possibly even most advantageous to your heirs. And that brings us to asset location. Again, I don't want to confuse asset location with asset allocation. Asset allocation is, again, what we talked about before, spreading investments across different categories of investment assets that have different risk characteristics so that our overall portfolio matches our risk tolerance. Asset location is different. Once we make a decision about that asset allocation, how much should be in stocks and how much should be in bonds, then we make a decision where we should put those assets. So the more tax-advantaged assets that don't generate a lot of taxable income should probably go in our taxable accounts or our tax-free accounts. Those assets that generate a lot of taxable income, our bonds that generate dividends, our stocks, our bonds that generate interest, our stocks that generate dividends, the location should probably be in our tax-sheltered accounts, our IRAs and our 401ks. And we fill up those tax buckets after we've made a decision about the proper asset allocation. We fill up those buckets or the asset location with the investments that generate less or more income. We put them in the right location. So it's, again, a strategy that we use to minimize our taxable income. Now, as long as we're getting the most out of our taxes, let's take a look at ways that we can also maybe benefit our heirs in our estate planning. And that's taking advantage of our annual gift tax exclusion. This is the amount of money that we can give away to beneficiaries without filing any gift tax return or paying any taxes. And so that amount in 2025 is $19,000. Now, this is per beneficiary per grantor. So a married couple could give $38,000 to one of their children. And if they've got 3 children, they could give as much as $114,000 without filing a gift tax return or paying any taxes. Now, you could exceed these amounts if you wanted to, because you can give more than that and only eat up your lifetime exemption, which today is quite large. It's $13.99 million. So you can give more to individuals than this annual exclusion, and still not pay gift taxes. You'll just have to file a gift tax return. Now, this does not include money that you would give to an individual to pay for certain qualified medical expenses, certain qualified dental expenses, and we can even pay tuition expenses outside of a gift qualification if we pay them directly to the school, as an example. So these payments would not count against our gift tax exclusion. And so be aware of that. Now, there's certain investments. We could talk about treasuries all day long. We could talk about tax-exempt municipals all day long, but let's just spend a few minutes on them because there is some advantage to investing in them if, in fact, we are living on some of our investment income to support us. Treasuries are ones that are generally safer with a relatively good yield. They're safer because they are backed by the taxing authority of the federal government. And so lots of times we feel very comfortable owning a treasury for that reason. But they are subject to interest rate risk. And that's the thing that I think a lot of people are not necessarily aware of. If we hold them to maturity, there's no interest rate risk at all. But if we do make a decision that we're going to sell them, if interest rates rise above the stated interest rate on our particular treasury, then the value of that treasury will decline. And so it's good to understand that. But the reverse is true too. If interest rates go down relative to our stated rate, our bond could go up in value. But as we noted before, treasuries have some advantages beyond security. There are certain state and locations where the income will be exempt from local taxes, so it's good to consider that. The other thing to give some consideration to is our municipal securities. These are things that when we buy a municipal bond, we actually are lending to our local governments to build hospitals, roads, schools. And so lots of times we like to do that. Quite often the municipal income is exempt from taxes. But the difference between this and a treasury is it is not guaranteed by the taxing authority of the local municipality. So taking a look at the credit rating of a municipal bond that you might be considering is important. It's interesting to note that Moody's, which does rate bond security between 70 and 2022, what is that, a 52-year period, only 115 of the Moody's rated municipal issuers defaulted. So while they're not guaranteed or perceived as guaranteed by the taxing authority of the federal government, they have proven to be very secure. And last but not least is giving assets to a charity. And one of the things that a lot of people, I think, are unaware of is they can give some of their appreciated assets to that charity. For example, if you have stock that is highly appreciated, you have the choice of selling it and giving cash to the charity, or you have the choice of giving the stock directly to the charity. And the advantage of the latter, obviously, is you haven't paid the capital gains tax. The charity won't pay tax on it either. So they receive the full value of your stock, not the after-tax value of the stock. And when they sell it, they will receive the full value of the stock. So quite often, We suggest charitable giving, not necessarily as the last tax strategy, but it can be the tax strategy that also makes sense from an investment standpoint. If you are charitably inclined, take a look at your investments and make a decision. Which ones might be the richest ones for you to give away to your charity rather than sell them? And so there's other alternative ways to do that for those folks who want to bunch, itemizing deductions doesn't work for you, yet you'd like to make your charitable contributions deductible. A lot of people bunch several years of intended charitable contributions together, give them to a donor advised fund, get the full deduction in that particular year, and make charitable giving both tax advantage to them and advantaged to the charity itself. So we don't want to leave charity as the last tax strategy, but quite often it's the most beneficial. So, in summary, I hope you've benefited from today's presentation and gained some insights and perspectives on your tax circumstances. Again, I want to emphasize that all of this tax information is important, but fitting these details into your financial circumstances really does take some work. You can take some of the observations that I made today, take a look at your 2024 return, and some of them will make perfect sense to you. But I really do feel that some of the strategies, Roth conversions, charitable giving, things such as that, really do take some additional consideration and some tax advice. And I recommend that before you do anything like that you do seek out a specialist in this area, either a strong financial advisor or your CPA. If you have any questions, again, please forward them to us through our website. You'll get into the contact information on sjboylewealthplanning.com, and you can submit a question there. You can also contact me. My email address is there. Contact me and ask me for a copy of this presentation, and I would be happy to send it to you. Again, it's been a pleasure to spend some time with you all today, and feel free to reach out should you have any questions as to how any of this might apply to your individual situation. We do give complimentary consultations as a follow-up to one of these presentations. Thanks very much. It's been a pleasure to have you.